Joining us now is the Bank of America Chairman and CEO, Brian Moynihan. Brian, good to see you.
Good to see you. Yeah. Howard and I were on a panel yesterday, and then yesterday, maybe the day before yesterday, then lunch today, and actually we're going to do another public venue where we're talking about how you raise the money to do all this investment he was talking about. So he's bullish on America, and he watched part of the interview. It sounds like he said that.
You guys are too.
Yes.
So let's start with the GDP forecast and
Sure.
the outlook.
So our research team, our research team is one of the best in the world, led by a woman named Candace Browning-Platt. And they all come out and they raised their GDP for the U.S. to 2.8% growth for the 26, right before we came to Davos. The world about 3.5. They raised it to 0.1. And the important things, I think, to think about the U.S. is you think about the travel from the last time we were here. Last time we were here, we probably had 2.5% for 26. Then Liberation Day, it drops all the way to 1.5. And then as a settling in of there's the four primary policies of the Trump administration, trade and tariff, tax, immigration, and deregulation started settling in. We've raised it back to 2.6 and now 2.8. And that's bullish. And then underneath it, we see what the consumer really does. And if we could talk about that, the consumer spending was strong in the fourth quarter. When I talk about that, it's $4.5 trillion, our 70 million consumers, which we're blessed to have, put into the economy a year. And that, for the fourth quarter, that grew about 5% over the 24's fourth quarter. And so far in January, it's growing a little faster than that. Now, you got to be careful about 2 weeks don't make a quarter, but it's staying up there strong.
Well, let's pair that GDP forecast with the bank and the business lines then. What position are you in to take advantage of that better growth story in America, and when do you expect it to show up?
Well, because of who you are, and we've been part owners in this company a long, long time ago, and Mike's built a good thing around the markets business. That's what you're always interested in, even though there's all this other stuff that makes a lot of money. But look, if you look at Jim DeMar, who's now co-president of the company, but his team in markets this year had their last quarter had their 15th consecutive quarter of year-over-year growth. They just keep walking up, 10% up for the fourth quarter. If you look at investment banking, which was kind of interesting, so Matthew Coder and team, early in December, we thought we were about $1.5 billion, and I went out at a conference and told people that, and lo and behold, we ended up $1.605 billion, and that made 2025 the second best year of investment banking fees in our company's history. And the only other one was pandemic, when everybody did a lot of financing. And next year, we think we're bullish because the pipelines are full, and the broadening out of the revenue stream into the IPO markets and other things, which got started a little bit this year, but have been pretty depressed for a while. So that's coming. And then deals, just the deal flow. People can get deals done. When I was here a couple Davos ago, the regulatory burdens were getting so high that you couldn't honestly tell a client who's trying to do a $5 billion deal to do it, because you said, if you're going to stabilize your company for 6 months, a year, trying to get this through, and you don't get it through, is that worth it? And that's sort of off the table. And even our industry, even though we can't do anything, 6 months approval timelines are back to where they should be.
It seems like there is an incredible amount of bullishness here at Davos about deals, about IPOs, about all sorts of transactions, and some of the issuances of debt and equity. At the same time, there's a real concern about affordability. Yeah. There's a concern about how well the consumer is going to be able to face off with inflation. I'm just wondering if this is the year that we see the two come together, because last year they didn't come together. We saw the same kind of joblessness in terms of the growth, and we saw the same kind of lack of enthusiasm in sentiment surveys.
Yeah, so if you look through if you think about last year, think about how bullish people were last year because about the United States and the change in regulatory regime and things like that. In April, things changed, and then by the end of the year, it changed back. And so I think that had a lot to do with it. If you look at the consumer, and what we see, that spending level is not consistent with people who feel they're threatened in the future, and they're spending on all kinds of things. Now, if you look at the research team, the Bank of America Institute, if you look at the work they've done, if you put three groups of customers, lower income third, middle income third, upper income third, they're all growing, but the middle and upper are growing at a faster rate, and frankly, that drives a lot of the growth. But if you look at what everybody's spending on, they're spending on going out to eat, they're spending on booking vacations, they're spending on essentials. So what's the affordability? It's the inflation that people remember, and that is going to take a while for people to kind of put in the rearview mirror, because people can remember. It's not too hard to remember pre-COVID where X cost you, a gallon of milk cost you this, a gallon of gas cost you that, your rent was this, and with that explosion in prices, wages also went up, but the consumer thinks more about the price side. And then the question of, will it turn over and get back in sync? And that's what's in those surveys. But if you watch your activity, and I'm a big believer in They'll tell you one thing, watch what they do, and that's what they're doing as of last Friday in the consumer base across 70 million people, which is a pretty good sample size.
They're spending a lot. Maybe they would spend even more if there was a 10% cap on credit card rates. I mean, look, this proposal got a lot of attention about a week ago. It feels like 3 years ago. And people pushed back and said it wasn't realistic, it wasn't feasible. We had Jamie Dimon come out and discuss about how try it and see what happens. What's your take on that? How realistic are you seeing those proposals as being?
So if you step back, we're all for affordability in financial products. So you guys have followed over the years what we did on overdraft fees, taking down by 90% over the course of 15 years. What we did on having a $500 loan account for $5, no interest rate, you could borrow an emergency loan of $500. 8 million customers have used that over the last several years, to give you a sense. So, and then we have a no frills credit card, no rewards, and other stuff that people might attribute. That is low rate. It's not all the way down at that rate. So I think the question is, can we figure out a solution where you can avoid the equal and opposite reaction? As our friend Lafayette said in the Hamilton song, every action has an equal and opposite reaction. So the equal and opposite reaction we all talked about last week, if you actually make this a policy, it can reallocate credit. That will slow down spending. It will slow down credit availability, and that might not be what you're trying to achieve. So can you do something on a go-forward basis, on the limited things? And even 1 year, if you had to go reshuffle the whole deck, that would be pretty interesting and to cause a lot of change in people's views of what they have available for credit. And you want people to have available for credit because that gives them the courage to spend. And so we're trying to figure out, we're all working, trying to figure out, okay, given the affordability, given the thought process, is a way that we can do something that might help without having that equal and opposite reaction, because that would not be good. Our point is to get the credit losses down to the point where you can afford that rate, you actually can never have a charge-off. And you start to think about who can get credit, that's the thing. So we're working hard. We're trying to come up with solutions like we are on some of the proposals around mortgage and 401k usage, and trying to think of how you maybe can move the transfer of wealth faster by giving people in my age bracket the ability to move a 401k balance to help their kid buy a house or something like that. We threw that out to Howard yesterday. There's these ideas of letting people use their own 401k with less. They can borrow from today, but there's a way you can actually just take a withdrawal so they don't have the added debt burden. And then you got to work on the supply side of housing. And the president was interesting. Yes, he's sensitive to the issue. If you bring down house prices to make it affordable, is that the right answer for everybody? But on the other hand, when you have the kind of over demand in some of the cities we work in, 30,000 units in Charlotte, 20,000 Boston, 30, 40,000, 100,000, whatever in New York, you could build a lot before I think you'd have a major impact on the downward trend in prices.
Well, the DJT imposed deadline of January 20th has come and gone for the credit card caps. Have you spoken to the administration about this issue and talked to them about the potential counterintuitive problem with a 10% cap?
The team and I talk to administration all the time about these policies and stuff, and they listen, and they're trying to figure out the same issue from their side. How can they make America more affordable? And I think the number one thing we can do to make America more affordable is keep everybody employed and earnings growth. In our client base, across 70 million people, we see a lot of paychecks come in, and that's growing at 3%, 4%, and that's a good number. And so that wage growth continuity it will ultimately make people feel different about it. But it's completely understandable why they feel this sort of unevenness of how these things came into their household and then what they want to do about it. And then rent affordability, we've given them the types of ideas I talked about.
We need to see some better hiring as well. Can we talk about hiring? The AI story, it's difficult to understand what's happened with hiring in this country, in America, over the last 12 months. What do you think has happened? What's your understanding of this drop-off in hiring? Is it a supply-side story? What do you think it is?
I think there's a concern of availability of labor because of the population growth, immigration dynamics that I think, again, the administration is trying to get much more fine around exactly what they're doing and not threatening people who've been naturalized citizens and things like that. And that was never what they're intended to do, but people started reading it. So I think, and now if you looked at our small business surveys, labor availability became an issue again, and it hadn't been for a good while. And so I think that's something we've advised the administration to be mindful of, because you don't want that to become a constraint on people's views of growing. Now, the big hiring story here, where Davos, and everybody keeps saying this year's about AI, last year was about AI, the year before it was about AI, the year before it was about AI. In 2019, the premise was the fourth industrial revolution, which was AI without just saying it. And so it's not a new theme. And so I give you, since the first time you probably asked somebody, leave aside the pandemic, say post-pandemic about, is AI going to cause you to change your hiring? Let's call it 4 years. Let's call it 3 years. We hired 65,000 people at Bank of America. 2,000 kids out of school, plus out of school every year. Now, and that's with a turnover rate 8%. We got to hire, in the month of January, we'll hire like 1,300 people, and we'll have the same head count we had in the month of December. Are these people doing exactly what the people left? Sometimes those jobs got eliminated. But that's what management is challenged, is how do you think to make the changes we got to make, the transformations, to make the customer experience the best it can be, to grow the company and to manage expense. And that means you have to really pay attention to the headcount movement, and that's why we watch it carefully.
That's where the tension is, though, I think, for a lot of people. Yeah. You've got the societal problem on the one hand, and on the other hand, you've got the opportunity. Yeah. And the opportunity is to do even more with what you've already got. Yeah. And that's the productivity story. Yeah. And that's what you're selling to investors. That's the pitch at the moment, isn't it?
So we had 285,000 people in 2010 when the team took over. We have 212,000 people today. And you never heard anything about labor dislocation because we just kept planning ahead. But that's the application of technology. Just take the consumer business, and I showed at Investor Day, 100,000 people to 50 and make it simple. And if you look at that, the business is 3 times as big in terms of transactions, activity. But that's the power of all you've got 8 devices sitting on the tables in front of you and the connectivity and what you'll do.
Just 2.
It's a combination of AI plus alerts and things like that. People that get focused on just, Erica growth in our case, you're saying, no, there's literally 1 billion alerts that go out, which is basically artificial intelligence. People set up in advance to tell them things go on. You don't need them to go into Erica to ask if a check went through my account above $2,500 if you set the alerts.
You said something that we reflect on a lot on our show. You said a lot of things, but one thing in particular, that the business would grow, but that your staff would stay about the same size. Yeah. And you said that about a year ago, maybe 2 years ago. That's a near-term phenomenon. Yeah. In 5 to 10 years, will it be the same? Or will it start to change in terms of actual shrinkage?
Well, if Howard's right, his view of growth, we'll need a lot more human content to keep up with it. And I'll give you the historical context. In 2019, I was in a room downstairs, and the people were wringing their hands, and that's the way they do at Davos, that this technology is going to take away the jobs. And so in preparation, I said, I've got to give some hope here. So I went and did the research. In 1969, America employed 80 million people. In 2019, we employed 160 million people. I think there was a lot of technology and change that came from 1969 to 2019. None of that stuff in front of you was available. You wouldn't have had a computer at work. You wouldn't have email accounts. You were still getting charged by the minute for phone calls. And think about that change. And think about we absorbed 80 million more people working. So I don't want to be Pollyanna about it, but I think you have to be optimistic that if we can grow the economy and grow the thing, we will absorb. And by the way, the population of the U.S. is very modest without immigration, and there's a natural 2+% of the people, or whatever it is, die every year. It's morbid, but that's what happens. And so you have births that kind of replace it, and people retire. And so that's why I think management's core challenge is to manage this through and get employees to take the spirit and help drive the growth in the company and be a part of the solution and help us make it happen. And my guess is, it might incrementally move headcount, but if we manage it through attrition and retirements and stuff, we ought to be able to manage the outcome.
How did we ever live without the Bloomberg terminal? Hey? What was that ever like?
I don't think I ever did.
Brian, just a final question for us. You mentioned Howard. Yeah. We talked about it, we joked about it at the start of the conversation, the relationship with the White House. How would you characterize it, in your own opinion, right now?
Oh, look, you always want to get an invitation. This is Davos, a place of invitation. So we invite you guys someplace you want that invitation. So the relationship's good. We do continue to give lots of ideas. And it was ironic that what was fun, we had a client dinner last night, and Howard came to talk to clients. It was delayed as they finished up the news on Greenland. And he was able to come in and talk about what happened. And those were international clients who admittedly were confused for 48 hours. And what I've tried to do with the administration's policies and talk especially to people outside the United States to say, listen to what they're saying and you can figure out what's going to happen. But don't confuse security with a trade policy. They wanted to get action, and they did. And that's a great thing. And you saw, leave aside the market reaction, which can go up and down on a day. What you saw is the clients say, OK, I got it. Now let's go set the business plans that will help have that growth in the future.